So you're looking at your screen and you see silver crash $10 in a single day. You're wondering why your stop losses got hit in the dead of night during a holiday week. Well, I'm going to tell you right now, you have to stop looking at the charts. Seriously, that price action you saw, that wasn't the event. That was just the aftermath. To figure out what really went down, we have to treat this like a crime scene.
You see, the chart is just the chalk outline of the body. All it does is show you where the victim fell. It doesn't tell you how or why. To solve this thing, we need to find the weapon. We need to identify the motive. And we've got to understand the timing of the attack. And that's exactly what we're going to do right now. We are going to run a full forensic analysis of this event. And we're going to uncover how it was engineered, who was behind it, and most importantly, what this all means for the future of physical metal.
Welcome to a Bullion Signal Special Report. We're calling this one the Silver Curtain Anatomy of a Forced Liquidation. We're about to break down how a quiet little rule change in Chicago was actually triggered by a massive geopolitical decision in Beijing. This created a violent crash in the paper markets, all designed to hide a pretty terrifying reality in the physical world. We're going to connect the dots that the mainstream media just completely ignored.
Look, our entire job here at Bullion Signal is to help you find the signal inside all the noise of global finance. And trust me, events like this are not random. They are moves in a much larger strategic game being played on the world stage. If this is the kind of deep dive analysis you value, do us a favor and join our growing community of investors. Just subscribe to the channel. We're all in this together, learning to see the patterns. All right, let's start with the weapon itself. This price crash wasn't because of some sudden wave of investors panic selling. No, it was triggered by a very specific, and let me tell you, a very powerful administrative tool. The exchange itself pulled the trigger. They fundamentally changed the rules of the game in the blink of an eye. And the craziest part? They did it right out in the open.
For most of last year, the price of admission to the silver futures market was, pretty manageable. To control a standard 5,000-ounce contract, you needed to post about $12,000 in collateral. Now, this let a lot of smaller hedge funds, family offices, even savvy retail guys get in on the action. And they did. They built up a record-long position, expecting a huge price breakout. The whole table was set for a big move up.
But then, on Friday, December 26th, while everyone was distracted with the holidays, the exchange more than doubled the cost to play. I'm not talking about a 10 or 20% hike. Nope. They jacked up the required collateral by over 100%, from $12,000 to $25,000 a contract, overnight. Think about that. An account that was perfectly fine on Friday was, with just a stroke of a pen, mathematically insolvent by Monday morning. And that was before the price had even moved a penny.
And when an investor can't instantly wire tens of thousands of dollars in new margin, a specific protocol kicks in. This isn't a person on the phone calling you up. It is a cold, unfeeling algorithm. It's called a Forced Liquidation Protocol. And it's an automated risk engine that just sells your position at whatever the market price is. It doesn't care about your research. It doesn't ask for permission. It just sells. This wasn't a panic. It was a purge.
You have to understand, in forensic economics, there really are no coincidences. There's only strategy. So if this margin hike was really about market safety, then why on earth would they do it during the single most illiquid week of the entire year? That period between Christmas and New Year's, it's known as Ghost Week. All the senior traders are on vacation, the order books are paper thin. It is, by design, the perfect kill zone for an ambush. So here's exactly how the ambush went down. Step 1, the announcement. A quiet little email goes out to clearing firms late on a Friday afternoon. Step 2, the calculation. Over the weekend, brokers start realizing thousands of their accounts are suddenly under-margined. Step 3, the execution. Monday morning as Asia opens, the margin calls go out, and most traders, still on holiday, they never even saw it coming. The computers just took over and started dumping everything. Of course, the mainstream financial news called it profit-taking or a technical correction. Please do not let them gaslight you. You do not get a 13% market crash in 4 hours from a little bit of profit taking. This was a deliberately engineered margin flush. It was the exchange literally kicking players off the table by making the game too expensive to play. That's the difference between the headline you read and the forensic reality.
And this move had 4 very clear, very strategic goals. First, just shatter the psychology of all the bulls who are betting on a breakout. Second, you got to break that strong upward price momentum dead in its tracks. Third, you forcibly remove what they call the weak hands, all those smaller leveraged speculators. And finally, and this is the most critical one, you clear the entire board. You reset the game right before the true physical shortage becomes undeniable.
But believe it or not, the story does not end there. See, crashing a market this violently, that is a really dangerous game. It creates ripples, and those ripples can threaten the whole system. And when you dig deep into the plumbing of the financial markets from that day, you find that this forced liquidation was so aggressive, it almost broke the entire casino. You find evidence of genuine, systemic panic.
Right there, buried in a footnote in the Federal Reserve's overnight repo data from that very same Monday is a quiet emergency liquidity injection of $34 billion. Now, why would they do that? Because as the forced selling spiraled out of control, the clearinghouses themselves were at risk of going under. The Fed had to jump in and grease the wheels to make sure the crash in silver didn't blow up the entire futures market. This is proof of how close they brought the system to a catastrophic failure.
This intervention from the Fed, that is the smoking gun. It proves just how desperate the exchange was. They were so determined to stop the price of silver from rising that they were willing to risk a full-blown systemic accident to get it done. The tactic they chose was so violent, it required the Federal Reserve to swoop in and stabilize everything. Which leaves us with the ultimate question. Why? Why take such an incredible risk?
Well, the answer to why isn't in Chicago. It's in Beijing. The banks and the exchange, they weren't just reacting to the market. They were front-running a massive geopolitical event they knew was just around the corner. They had a calendar, and they knew that on January 1st, a big red curtain was about to fall on the physical silver market. The sell-off was a preemptive strike, triggered by a bureaucratic decision made halfway around the world.
When you just lay out the events on a timeline, the connection becomes impossible to ignore. On December 26th, the margin hike is quietly announced. On December 29th, the forced liquidation crashes the paper price. And then, just 48 hours later, on January 1st, China implements a new export licensing regime for silver. The crash in the West was perfectly timed to happen just before the supply lockdown in the East.
To really get what China did, you have to understand this term, dual-use goods. It just refers to any material that has both civilian and military applications. Now, in the world of geopolitics, you never just declare a ban. That's considered an act of war. Instead, you just reclassify a resource as dual use. And with a single line of code on a government website, silver went from being a simple commodity to a strategic national security asset, subject to very strict export control.
And here's how a soft ban actually works. You don't say no. First, you require a special export license. Then, you stamp the application pending. Then you ask for more paperwork. You delay the shipment for 30 days, then 60, then indefinitely. The physical silver just sits on a dock in Shanghai, the ship sits empty in the harbor, and the global supply chain is effectively cut, all without a single hostile shot being fired.
You know, this whole thing brings up a really critical point about just how fragile our modern world is. So much of it depends on these obscure little components and choke points that we never ever think about until they're gone. I'd love to hear what you think about this. What's the most overlooked piece of the global supply chain you've seen? Drop a line in the comments below. Now, a lot of Western analysts made a huge mistake here. A fatal error, really. They looked at mining charts and said, China only mines about 10% of the world's silver. This is no big deal. They completely missed the most important part of the entire equation. It's not about who digs it out of the ground. It's about who refines it into its usable form. And China, Well, they've spent decades building out their infrastructure, and now they control over 70% of the world's silver refining capacity.
This right here is the crucial point. You can't just put raw ore from a mine into a solar panel or a missile guidance system. It doesn't work that way. You need 99.99% fine silver, as our source material puts it so perfectly. The raw silver might come from a Mexican reservoir, but the faucet, the refinery that turns it into a product you can actually use, that faucet is in China. And on January 1st, they turned that faucet off to the rest of the world.
The major bullion banks have huge offices and deep intelligence networks in Shanghai. They didn't read about this in the news like the rest of us. Oh no. They knew this policy change was coming. They saw the writing on the wall weeks, maybe even months in advance. This is exactly the kind of signal that our Bullion Signal community is dedicated to tracking. That gap between the official story and the on-the-ground reality. The banks knew a supply shock was coming. And knowing this put them in an absolutely existential dilemma. The banks were holding these massive short positions, basically betting the price of silver would go down. But they also knew that on January 1st, the physical supply was about to vanish. And when supply vanishes, price goes vertical. If the price had spiked while they were short, they would have been completely wiped out. They were caught in a perfect trap, one of their own making, and they had to find a way out, fast.
So the banks were trapped. They knew the physical market was about to lock up, which would make their paper short positions absolutely catastrophic. So what did they do? They used the rules of the paper market to engineer a crash, create total chaos, and escape the trap just 48 hours before it slammed shut. Now, in part 2 of this special report, we're going to detail how they pulled off this perfect heist, what the resulting split between the paper and physical price actually means for you, and most importantly, the strategy for how you can navigate what comes next.